information for exercises for the next couple of slides. So suppose this company just paid, okay? So whenever you see this this wording just, this would indicate it has been paid in year 0. Just paid a dividend of 0.50 cents and expected to increase the dividend by 2% per year. So, and if the market required rate of return was 15%, then how much should the stock be selling for? So you're looking for the price here. So from the problem here, you should note that the dividend, which has just been paid, so D sub 0 is 0.5. The growth rate is 2%. The required rate of return was 15%. So given so, if we just put those variables into the formula from the previous slide, then you will see that P sub 0 is supposed to be D sub 0 times 1 plus G to the G divided by R minus G. D sub 0 is given, G is given, R is given. Alright, so you can just simply use the formula here to figure out the price for now, which is 3.92. Okay, as simple as this. You don't have to do any like present time value of money calculator work for this chapter. It will be, this would be just this simple calculation. Let's move on to exercise 2. So this company is expected to pay a $2 dividend. Note that the wording has changed. It was just paid. It was a past tense before with exercise 1. However, in exercise 2, you can see it's just for the future tense, okay? It's expected, it will pay $2 for dividends in 1 year, in 1 year. So what that indicates is D sub 1 should be 2. It's expected to grow at 5%, so the growth rate is 5%, required rate of return is 20%. So all these pieces of information, the variables are given, and your job is to just put that into the formula. The P sub 0 was D1 divided by R minus G, so it's either D sub 0 times 1 plus G as your numerator or just simple D1. But here the information given was D sub 1, so you just put that in, 2 divided by 20% minus 0.5 or 5%. Then you would figure out that the price is 13.33. Right. Okay, and then exercise 3. The first part of exercise 3. Gordon Growth Company is expected to pay a dividend of $4 next period, and dividends are expected to grow at 6% per year. And the required rate of return is 16%. So expected to pay, meaning that dividend 1, D sub 1 would be $4. So D sub 1, $4, growth rate 6%, R 16%. The current price, if you just plug that in, it's simple as this. Okay, it's going to be $40. The current price is supposedly $40. This was a simple just starter. But let's just move on to more developed version. Alright, so 3B. What is the price expected to be in year 4? So let's just suppose that, dividends are going to be paid out at this pace, continuously at 6%. Dividend 1 was $4. And you are looking for not the price in year 0, but year 4. So this is where you'll have to apply the dividend variation that I introduced. So if you think about it, if you're looking for dividend 4, okay, price 4, sorry, then, so this was when we are looking for price 0. And you were using all the dividends until infinity. And if you think about time 4 or year 4, from infinity, if we just reflect back, or if you look back, year 0, it takes like infinity, right, to arrive at like this infinite certain period of time. Same thing with year 4. Even if you started from year 4, the time remaining is still infinity. So it doesn't really matter where you start. As long as you have an infinite model, no matter where you start, you will still have to use an infinite model. So P sub 4, if you're looking for P sub 4, all you need to do is just add a little bit of tweak so that we can still use the infinite model to look for that price, okay? So when we're looking for P sub 0, then it was D sub 1 divided by R minus G, right? Just like that. If you're looking for P sub 4, Then, okay, P sub 4 we can just treat as if this were our 0, okay, the starter. P sub 4 is our starting point. Then, as you can see, when we were trying to figure out P sub 0, it was 1 period ahead. Okay, D sub 1 was 1 period ahead. And then, using that, you could figure out P sub 0. Just like that. We are going to use 1 period ahead, okay, D sub 5. And then use that as our numerator because, once again, this is our starting point. 4 is our new 0. 5 is our new 1 then. Okay? Then you divide it by R minus G. So the question becomes figuring out D sub 5. How do we figure out D sub 5? So D sub 5, if you take a look at it, D sub 5 is D sub 0 times 1 plus G to the power of 5. Or maybe, as we saw before, D sub 0 can be broken down into D sub 0 times 1 plus G. So that can be D sub 1, and then you multiply that by 1 plus G to the power of 4. This is what I said earlier. So if you just take a look at the subscript, where you start off with as in terms of the base dividend, you multiply that by 1 plus G to the power of the remaining time period. So starting from 1, if you want to arrive at D sub 5, the remaining time period is 4. So you just take the power of 4, then you will arrive at D sub 5. Okay, so that's the rule of thumb. Okay, so whatever base dividend you're starting with, you just multiply that by 1 plus G to the power of remaining time, then you will arrive at this dividend that you're looking for at that certain period of time. Of course, that's only viable when you're using the constant growth model. Just keep that in mind. We're still working in the framework of constant growth. So applying that, if we want to figure out dividend 5, so dividend 1, starting from dividend 1, which was 4, then you multiply that by 1 plus 0.06% to the power of the remaining time period, which is 4. Okay, so we're using this formula right here, and then that would give us 5.05. So with that, if we just come back to the formula that we wanted to use, our objective formula here is P sub 4 divided being equal to D sub 5 divided by R minus G, right? So that means P sub 4 is D sub 5 divided by R minus G, 5.5 applied here, divided by R minus G. Then you will see that the price in year 4 should be $50.5. Okay, the key here was that A, we are just making a shift in terms of the time horizon for our starting point to be year 4. Then your model could be adjusted to like dividend 1 year ahead, which is 5 in this case, divided by R minus G. That's the first takeaway here. The second takeaway here is that if you're looking for dividend at some future point, then whatever dividend you're given, you multiply that by 1 plus G to the remaining time, to the power of the remaining time period, then you should be able to get that dividend. Okay, so these are the two key takeaways from this exercise. And then let's move on to the last part of exercise. So with this information given, let's look for the implied return or the return you would be making by investing in this stock during the 4-year period. So you supposedly, so P sub 0 was 40. And then P sub 4, I believe, P sub 4 is 50.5. So let's suppose that you first purchased the stock at $40 and you're selling it at 50.5. Or maybe you just are holding this stock for a 4-year period. So why don't we just call this return or implied return or the price change as RET or return, RET. And then if you want to figure out the change in price, that growth rate will be P sub 0 growing or being compounded at 1 plus this RET or return to the power of 4. And if we look for this return, that would be equal to 6%. If we just use this price information, we would obtain 6%. And also it can be more easily done with the calculator work, and then once again it will give us 6. Okay, so this 6%, if we try to recall this information from earlier exercise information, this is the same thing as G. Note that our growth rate was 6%. So here our key takeaway is that the price growth should be the same rate as the dividend growth rate, okay? So if we are applying the constant growth model, your price growth or the return that you're getting from this stock's price growth is supposedly the same as the dividend growth rate. And once again, given that the stock price, the yield that you're getting purely from the stock price increases, that would be called capital gains yield. So capital gains yield would be equivalent to the dividend growth rate. Let's look into the return more in detail. So using the dividend growth model or the constant growth model, if you want to figure out the R. So P sub 0, which is equal to dividend to D sub 0 times 1 plus G divided by R minus G. Let's rearrange the equation and solve for R. Then we can just swap the denominator and the left-hand side. So R minus G, let me just write it down. Then what you can see is if you just swap this part or maybe this part, then R minus G would be equal to D sub 0, 1 plus G, 2, 1 plus G, and then you divide it by P sub 0. If I just swapped this denominator in the left-hand side, then once again, after it's done, you can just move G to the right-hand side by adding it. So G plus D sub 0, 1 plus G divided by P sub 0. So it can be just written this way. Or maybe you can just replace the numerator with D sub 1. All right, so it can be just written either this way or this way. Whatever you're using, you can see that it's just split into two parts. One is like the left part, which has to do with the dividend, or maybe it's called the dividend yield, okay? Dividend divided by dividend in year 1, or dividend 0 times 1 plus G divided by price, okay? So this would be dividend yield, and you would have G, which is dividend growth. So in a sense, you can see that your required rate of return is split into two parts, dividend yield and dividend growth rate. So what is the dividend yield? What is the capital gains yield? So let's just look at that. So if we just take a look at an example here, let's suppose a firm's stock is currently selling for 10.5. So this is the current price. And it just paid, so dividend 0 would be $1. And the growth rate is expected to grow at 5%. And with this information, we would like to figure out the required rate of return. If so, if we just input this information, P sub 0 being 10.5, D sub 0, 1, G being 5%, then we can figure out that required rate of return is 1 times 1 plus 5%. You divide it by the price of 10.5, and then you add 5% as well, which will be equal to 15%. So that's how you figure out the required rate of return. From here, we would like to decompose this required rate into two parts, dividend yield and capital gains yield. If you want to look into that, you can see that the first part, as we saw before, which has to do with the dividend, and then you divide it by price, right? The ratio between dividend in 1 year and then the price right now, this would be dividend yield, okay? Per $1 of share, how much dividend is being paid or is expected to be paid. That will be equivalent to the dividend yield. And the rest of the part will be the capital gains yield, okay? Note that from our exercise 3C, we saw that price is growing at the same rate as the dividend growth rate. That's why it could be called capital gains yield. So you can see that the required rate of return can be split into dividend yield and capital gains yield. So let's summarize everything that we discussed regarding the constant growth model. So first, the dividend is expected to grow at a constant rate of G forever. And what that means is stock price growth is going to be the same as the dividend growth rate, meaning that it will grow at G forever as well. And another name for it would be the capital gains yield. So expected capital gains yield would be constant and will be equal to growth rate. Another thing to note here is that the dividend yield, which is dividend 1 divided by P sub 0, is supposed to be constant. So put that together, the total return from this stock investment must be greater than G. and would be the sum of dividend yield and the growth rate G. So expected, just to put that together, expected total return would be equal to expected dividend yield plus expected capital gains yield. And expected dividend yield would plus expected growth rate, which would be the same thing. So this is the key takeaway from the constant growth model. Now let's take a look at the last model in this chapter, which is the non-constant or supernormal growth model. So what this model is assuming is that dividends are growing at a given rate of, say, G sub 1 for a certain period of time until year end. And then after that, it's going to change the constant growth rate and grow at a different rate, say G sub 2 thereafter and perpetually. So we are looking at multiple growth rates. If we were assuming that, then until year end, the dividend schedule would follow just as we saw in our earlier model, which is constant growth model. However, after year end, it will be like a cutoff point, and after the cutoff, your dividend will be growing at a different growth rate. So your dividend from year end multiplied by a different growth rate, 1 plus G sub 2. That will give you a new dividend for year end plus 1. So if you wanted to kind of generalize that dividend, the dollar amount of dividend, then it will be the amount that you saw before, which is D sub 0 times 1 plus G sub 1 to the power of n. That will be your D sub n. After that, you're multiplying that by 1 plus the new growth rate. Then this will give you the new the dividend to start with from year end plus 1. And then after then on, it will always be the new growth rate. So the only thing that will change will be the power that you see here. So if you put the dividend schedule on a time frame, it would look like this. So until year end, dividend will be growing at a constant growth rate of G sub 1. And in year end, there will be a shift in the dividend growth rate, and after that, the dividend will grow at G sub 2. That's why you will have to multiply this value by 1 plus G sub 2. So if you want to kind of generalize this problem and see how we can actually compute the price of the stock in year 0 with a schedule given like this, the key here is that you'll have to split the time frame into two parts, and the cutoff will be year end. So we're gonna just split this time frame, and we will approach it from we will approach it backwards. So starting from the latter period, we will start from here, and then we'll just move to the first half. So how do we do that first? Step 1 here is that note that if we just take a look at, just focus on the latter stage, year end, we are starting from year end, and then we're moving on to like infinity. So from year end to infinity is perpetuity. So if you just split and just separate this into an independent section, year end is more like our year 0, and year end plus 1 will be like year 1. So this is our independent infinity period where a constant growth rate of G sub 2 is being applied. So we can actually just focus on this period and use constant growth model so that the value of the firm in the starting period, which is like our 0, but as a whole, this will be year end. Our P sub n can be computed. So let's just figure out the value P sub n by applying the constant growth model. All right, so that will be that will be our like middle point. And after taking the first step, we're going to come back to the earlier stage or first half, this one right over here, from year 0 to year end. Step 2 will be applied. How we can figure out P sub 0 is always like the NPV, or the sum of the present values of all the dividends, all the cash flows, year 1, year 2, all the way down to year end. And also, if we had no like cutoff, it will be just dividend year end, n plus 1, all the way to infinity. So that was supposed to be how to compute the value of the firm in year 0. But then what you can note here is that all the sum of dividends from year n plus 1 through infinity, these dividends have already been taken care of in one value, which is p sub 1. So if we just replace this part with p sub 1, then it would still work, okay? This would be just completely explained, okay? This has already been treated. We already took care of all these dividends to be able to figure out how much it would be worth in year n, which is the value of stock in year n, okay, p sub n. All right, so we're just replacing the whole thing with p sub n. Then what it means is the value of the firm in year 0 would be the sum of all the dividends until year n. And then the latter stuffs, the latter dividends are taken care of in p sub n as well. So if we just take the sum of the present values of all these things, then we are able to compute the value of the stock in year 0. Let me just put that, reiterate it. Step 1, use constant growth model to find value in n, okay, or p sub n. So to be more precise, we are looking for the present value of all dividends that are going to grow at g sub 2, okay? So that can be applied, the constant growth model. So if we just apply that, our value in year n will be d sub 1, all right? D sub n plus 1. The dividend in 1 year ahead, as we have treated the constant growth model in the earlier section, okay? Remember, this is our new 0 and this is our new 1. That's why we're using this to compute the value in year n, all right? So this will be our numerator divided by r minus g. In our g, the growth rate will be the new growth rate g sub 2. Okay, so using these dividend in year n plus 1, you divide it by r minus g2 so that you get the value of the firm in year n. That will be the first step. Second step, with all the cash flows that you can figure out until year n, and together with these dividend schedules, you are taking into account the value in year n, which takes care of all the dividends afterwards, okay? You're going to put that all together and find the present value of all these amounts, okay? Take the present values, sum them all, so that we can get the present value of all the dividends, okay? Which is equal to the stock value in year 0. So why don't we try to compute this? Just try to take care of this with an actual example. So a common stock just paid a dividend of $2. The dividend is expected to grow at 8% for 3 years, then it will grow at 4% in perpetuity. So 8% will be our growth rate g sub 1, 4% will be our growth rate g sub 2. The discount rate or the required rate of return was 12%. And here, note that it said dividend was just paid, okay, so meaning that d sub 0 was $2. So with given information, let's try to find out the stock value in year 0. So let's just draw, it's really important that you draw a timeline, and we can actually figure out the dividends until year 4, 1 year after the cutoff. So note that the cutoff will be year 3. Whenever you're trying to solve a problem, you will always be given the cutoff period, okay? Which is like when the last period where g sub 1 will be applied. So let's figure out the dividend schedule until year 3, and even after that, you can figure it out for 1 more year. That's all you need. 1 year after the cutoff, okay? That's all you need, okay? All right, so you got these values, and let's apply step 1. Step 1, we want to figure out p sub n, and n, which is cutoff at this point, will be year 3. So let's figure out p sub 3. Okay, so constant phase beginning in year 4 can be valued as a growing perpetuity at time 3. Okay, so this will be used to figure out p sub 3, and that will be, so the amount after you calculate this, it will be 2.62, and 2.62 will be your numerator. You divide it by 12% minus 4%, r minus g sub 2, right, g sub 2. Then you'll have 32.75. Okay. So your second stage or second half or first step has been tackled. And then let's come back to the first half, which is your step 2. Step 2 will be computing the present value of all these dividends until year end. And also this value in year 3, because this is taking care of everything like after this point. So using all these amounts, so 2.16, 2.33, 2.52, and also 32.75, all right? We are trying to figure out the sum of the present values. We'll have to get the present values first and add them all together. Note that for this piece of 3, because this is measured in year 3, this is, in terms of the timeline, it's located at the same time as this 2.52. So they can be put together, right? And then if you just solve for this equation, you will have 28.89. So 28.89 is how much the stock is worth in year 0. And there are going to be cases that you are not given the growth rate for the first phase, but all the dividend amounts will be given like just random numbers. So let's say the stock just paid a dividend of 1.5, and then for the next 3 years, you're expecting them to be like 2, 2.1, and 2.2. So the actual dollar amount of dividend schedule is given. And then finally, after year 3, a new growth rate will be applied, which is 4%. Then it's actually easier than exercise 5 in that the dividend amounts are already given to you. And after this cutoff, which is year 3, you are experiencing a growth rate of 4%. So let's just still call it as G sub 2. All right? And this will allow you to figure out how much the dividend in year 4 would be, 2.2 times 1 plus 4%. With that, our first goal is to figure out the value of the stock in year 3, right? So using this as our numerator, okay, 1 year ahead, dividend 1 year ahead, okay, you divide it by R minus G2, and you will figure out that this is $28.6, okay? How much the stock is worth in year 3? It's going to be 28.6, which is basically the sum of the present value of perpetual dividends that grew constantly at 4%. Now that you have your middle point, you're coming back to the first half or the second step, so that you're using all these dividend amounts until the cutoff. Also, the value in year 3, let's figure out their present values, okay? And if you just did this calculation, you'll see that it's $25.3. So we have been learning the dividend discount model using dividends as the cash flows for stock valuation. But the one thing to note here is not all companies pay dividends. So there are going to be some companies such as small growth companies who would frequently plow back everything and pay no dividend. So for them, the plowback ratio B would be equal to 1 and dividend payout ratio would be 0. If that were the case, there are no dividends to use for stock valuation. So that means if we were to use dividend discount model, those shares will be worth 0, present value 0, right? Does that really mean that the stock price, the value is like 0? Or is there any other methods to value those non-dividend paying stocks? Yes, there is. There is an alternative measure that we could use, which is called valuation with multiple. So we're going to use multiple or ratio analysis. So for stocks that do not pay dividends, we can value them using the P ratio or the PS ratio, price to sales ratio we learned in chapter 2. So if you were to use price to earnings ratio, which is more of a norm, then the price of a certain stock at T that we are interested in valuing, then what we can do is we're using P ratio, which is price divided by earnings. How much investors value a stock per $1 of earnings, right? That was the definition of P ratio. And then, so we're going to take a benchmark P ratio, a lot of times from the industry average or among its peers. We're going to take the benchmark P ratio, multiply that by EPS of that firm. So let's say the firm was, let's say it was firm I, and this would be the benchmark's P ratio. Multiply that by 2, and conceptually, if we were to take this P ratio as what's supposed to be the target P ratio or the what the P ratio of that firm is supposed to be, then what can be done is conceptually it can be just canceling each other out. Then the remaining price, we can take that as the value of that stock. So benchmark P ratio, if it is given, you multiply that by the current level earnings per share of that firm, and that would give us the estimated value of that stock. Same logic can be used with price to sales ratio. So benchmark price to ratio times the firm's current sales per share, and that would give us the expected price level of that firm. Then when do we use price to earnings and when do we use price to sales? A lot of times price to earnings ratio would be more popular, but price sales ratio can be especially useful when earnings are negative. If earnings were negative for that firm, then your price will turn out to be negative, which doesn't make any sense. So if that were the case, you would go with price to sales ratio. So let's do an example. So let's say an industry price to earnings for a company was 20. So this would be your target or benchmark P ratio, and predicted earnings was 2.5. With this information, if the company did not pay any dividends, then if you wanted to find out the target price or the estimated price, then that would be the benchmark P ratio of 20 and multiply that by current level earnings per share, and then you would end up having $50 as your target price. Lastly, if you want to find out a piece of information related to a stock, a share, a company's share, then you can go to finance.yahoo.com. Just try to search the company's name, and the first page that you will hit would look like this. And then you might as well just look at the summary tab, which will convey all the information related to a company's a common stock. So previous close. So the price is real time, and then I think what's more important would be to look at the bid and ask price. So bid would refer to how much you can just sell it at, and if you want to buy, then you will have to just check out the ask price. So these are the more important part of this tab, and also you can check out the information like the trading volume, and also market cap, the risk level as well. All these pieces of information would be useful for your stock investment, and further details can be checked out in the subsequent chapters as well.